Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Louis, and I'm excited to have you join us today. As we begin this episode, let's take a look at some of the latest news from around the globe that's impacting the financial markets. We're seeing some significant developments in Russia that could have far-reaching implications for investors. According to recent reports, Russia is facing a growing risk of depleting its National Wealth Fund, also known as the NWF, due to declining oil prices and a strong ruble. The fund, which was established in 2008 to manage the country's oil revenues, has been used to finance various projects and support the economy during times of crisis. However, with oil prices currently hovering around $52 per barrel, well below the $69.7 benchmark assumed in the budget, the Russian government is facing a significant shortfall in revenue. This has led to plans to withdraw an additional 447 billion rubles, or approximately $5.8 billion, from the fund to cover the expected budget deficit. Now, some analysts are warning that if oil prices continue to remain low, and the ruble stays strong, the NWF could be depleted in just over a year. This would not only limit the government's ability to finance its projects, but also increase the country's reliance on external borrowing, which could lead to higher interest rates and decreased investor confidence. On the other hand, some experts argue that the Russian economy has shown resilience in the face of adversity, and that the government has taken steps to diversify its revenue streams. They point out that the country's non-oil sector is growing, and that the government has implemented policies to support small and medium-sized businesses. As we consider these developments, it's essential to remember that the situation is complex and multifaceted. While there are certainly challenges ahead for Russia, there are also opportunities for growth and investment. We'll be keeping a close eye on this story as it unfolds, and exploring its implications for investors in more depth throughout this episode. So, stay tuned for our analysis and insights from the world of finance. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're still with us as we dive into the latest developments in the world of economics. Today, we're taking a closer look at the recent inflation readings and what they might mean for the Federal Reserve's next move. According to the latest data, the Consumer Price Index, or CPI, rose by 0.1% in May, which is lower than expected. The core CPI, which excludes food and energy prices, also increased by 0.1%, coming in below forecasts of 0.3%. This has led to a decrease in expectations for inflation, with the year-over-year rate rising by 2.4%, matching consensus expectation. Now, let's break down what this means. The lower-than-expected inflation reading is likely to put pressure on the Fed to consider cutting interest rates. In fact, expectations for a rate cut in September have risen above 75%. However, it's essential to note that the impact of higher prices from tariffs will take time to transmit through the economy. The American Institute for Economic Research's Everyday Price Index also reported a modest increase of 0.8% in May, reaching 294.3. This index has now recorded 6 straight months of increases. The all-items consumer price index rose by 0.1% in May, driven primarily by a 0.3% increase in shelter costs. We've also seen reactions from investment managers and economists, with some advising clients to take advantage of near-term volatility to move towards longer-term strategic allocation. Neuberger Berman's chief investment officer, Shannon L. Secoshia, notes that combining today's inflation read with last week's jobs data makes it hardly surprising that expectations for a Fed rate cut have risen. As we analyze these developments, it's crucial to consider multiple perspectives and avoid making any hasty conclusion. The interplay between inflation, interest rates, and economic growth is complex, and we must carefully weigh the potential implications of each new data point. For now, it seems that the markets are pricing in a higher likelihood of a rate cut, but it's essential to remember that the Fed's decisions are never made in a vacuum. The ongoing trade tensions, geopolitical developments, and shifting global economic landscape all play a role in shaping the central bank's monetary policy stance. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We've had a fantastic show so far, discussing various aspects of risk management and investment strategies. As we approach the closing segment, I'd like to shift our focus to an exciting development in the field of biotherapeutics. Recently, ImmunoPrecise Antibodies announced a breakthrough in their AI-designed GLP-1 peptide program. According to their press release, these peptides have shown promising results in receptor activation studies, surpassing semaglutide, a well-established treatment for type 2 diabetes and weight management. This achievement is significant, as it demonstrates the potential of AI-driven drug discovery in creating effective and targeted therapies. ImmunoPrecise's proprietary HIFT technology and LensI platform have enabled the company to design and develop these peptides with built-in biological relevance, which could lead to more efficient and scalable production processes. While this news is undoubtedly exciting for investors and patients alike, it's essential to maintain a balanced perspective. As with any emerging technology or treatment, there are risks and uncertainties associated with AI-designed therapeutics. Regulatory acceptance, clinical validation, and potential competition from established players in the market are just a few factors that could impact the success of these peptides. ImmunoPrecise has partnered with 19 of the top 20 pharmaceutical companies, which suggests that their technology is gaining traction within the industry. However, it's crucial to remember that the development and approval process for new therapeutics can be lengthy and unpredictable. As we consider the implications of this breakthrough, it's essential to weigh the potential benefits against the potential risks. Investors should carefully evaluate the company's financials, management team, and competitive landscape before making any investment decisions. In conclusion, the advancements in AI-designed biotherapeutics are undoubtedly intriguing, and ImmunoPrecise's achievement is a testament to the innovative spirit of the industry. As we navigate the complex world of risk management and investment, it's crucial to remain informed, cautious, and adaptable. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.